Time now for the markets with Leighton, and you say we have some new supply-demand numbers from the government.
They were released Thursday morning, Artis, and we will have some analysis here. Also ahead this week, U.S. catfish processing continues to dip. The dollar index could impact the calf and fat cattle market, and future pork demand in China is a concern for U.S. producers. We begin with the February 9th supply and demand numbers out of D.C. Drovers Cattle Network calls these reports neutral for the corn market. USDA increased corn exports by 50 million bushels and cut ending stocks by 45 million. Now, the soybean figures in the reports were called bearish by most of the trade. U.S. bean ending stocks were left unchanged and South American production was trimmed. All of this is exactly what broker Nolan Cullen expected when I talked to him over the internet Wednesday afternoon. Nolan, what is the market expecting as far as the new crop reports?
Well, most of the forecasts are out, and in general, the market, specifically to corn, is looking for some reduction in the government's figures from their last number of 846 million, which was a bearish surprise. The general consensus is we should see at least a 50 million bushel reduction in carryout, and of course, this should come from the weather problems being experienced in the southern hemisphere in both Brazil and Argentina, looking for fairly substantial 20% reductions in crop in those areas. In the cases of soybeans, we'll probably see very few changes. The last government figure was 290. The market's looking for some reduction based on the South American situation, but in fact, there is talk that maybe Chinese exports will also be reduced since sales are running somewhat behind. In the case of wheat and cotton, we don't see many changes taking place there. There'll be minor changes, but the trend in those markets has been that the government will in fact raise carryover based on adequate production worldwide in wheat and because of declining business in the cotton market. There is one risk to the downside here. Over the last several weeks and since the last government report, we've had a substantial buildup in the fund long position. So therefore, if these numbers don't come in a bullish posture, we could see some downside risk on the very short term.
And really here we're talking about a tale of two crops, so to speak, when we talk about old crop versus new crop at this time.
That's correct, Leighton. We're in a key situation here. We don't have anything in the ground. We've harvested the old crop. We make projections on the carryout figure. And at this point, we can look at the market. And for example, in corn, the spread is over 70 cents premium to the old crop over new crop. I think the market's telling us they're concerned about available supplies now. So the old crop would be bullish. In the case of new crop, projections are as much as 94 to 95 million acres of corn planted. That's a bearish situation. So we look for the spreads here to tell us whether this supply situation will continue to tighten. In the case of soybeans, a month ago the market was at a premium old crop to new crop, and that market has gone to a slight discount at this point in time. And this is mainly because Chinese exports have slowed somewhat. In that case, we would look to be bearish old crop, bullish new crop because of the unknown South American production yet, and whether soybeans will need to buy acres from corn later in the year.
Let's give you our bean-related trivia quiz to think about before proceeding on. How many bushels of soybeans does the Mississippi catfish industry use each year? Could the answer be 1 million, 2.3 million, 4 million, or almost 5.5 million? That answer will be coming up. Well, U.S. catfish prices are still up. Let's look at the latest government snapshot of this industry next. This reflects activity during the month of December. The average pond bank price being paid to U.S. producers in December was $1.25 per pound. That is 39 cents per pound higher than 1 year ago at that time. Farm sales totaled over 22.5 million pounds round weight. That is a drop of 35% from December 2010. Processor sales were just over 11 million pounds. That is a drop of 33%. The beef sector is an export-dependent market these days. Consequently, the dollar index could impact the calf and fat cattle market in a big way. Analyst Darren Newsom says the dollar index is giving some mixed signals, which should be monitored in the beef sector.
We've had a nice run in it. It certainly looks like it wants to continue higher, but it's getting a little bit overdone at this point. We're seeing some more bullish economic news coming out that takes some of the steam out of the dollar. We've recently seen the Federal Reserve saying they're not going to do anything with interest rates until 2014. That takes fundamental support out of the dollar. So I think once the situation in Europe calms down a little bit, and if we start to get a better feel for that, the euro may start to gain some strength, and that's going to put some pressure on the U.S. dollar index. I wouldn't anticipate it to be long term. Maybe over the spring, see it sag a little bit, then come back later in the year.
Meanwhile, over in the hog sector, there's some fear that demand is going away as a bigger hog herd and the numbers continue to grow. Analyst Sue Martin says China may be the wild card here due to the crucial nature of our export sales to that country.
They're buying hogs. The demand for pork has been pretty good. We need to see how much China's been buying. I think consumption of meat is slowing down in China, and so that may be a concern for hogs. But I think overall, you're looking at two bullish markets. They may go for a setback first and then come back again.
Before the feature, let's look at the answer to our trivia quiz. This week, that answer is D. The Mississippi catfish industry uses almost 5.5 million bushels of soybeans each year.